Broadcasting from the Investor Hour studios and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes, Google Play, and everywhere you find podcasts for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here's your host, Dan Ferris.
Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Today we'll talk with Herb Greenberg. Herb is well known, has been around a long time. He's well known for short ideas. Now he's turning his research to the long side. We'll talk about that today. In the mailbag today, questions about value stocks, banks, gold, and more. Big mailbag this week. Well done, folks. And remember, you can call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my opening rant this week, I'll talk about return on equity, AMC, gold, and apes. That and more right now on the Stansberry Investor Hour. Very quickly, let's talk about the last of our 5 financial clues, as I promised I would. So we talked about free cash flow, consistent profit margins, good balance sheet, shareholder rewards, and the last one is return on equity. Now, return on equity is really just income over equity as a percentage. So a high return on equity is good. But again, a consistent return on equity is best. A consistently high return on equity is really what you look for. Now, equity is influenced by debt. So if you have a tiny little slice of shareholders' equity, your return on equity number is going to be through the roof. Most of the stocks that I like don't have a lot of debt, right? But if they do have more debt, we have to think about other return metrics that make sense, like return on assets or return on invested capital sometimes. There are different return metrics we use, but return on equity is the one for equity investors, I think, right? You want to return on the equity, on the money that you put into the business. So this is good because you need some way of determining if the capital that you're putting into a business is being used productively enough and getting a high enough return. So that's why I use return on equity or assets and other return metrics. You just want to say, is this the most productive use of my capital, or could I put it elsewhere and compound at a higher rate, right? Return on equity, I like to say, is like if a business were a bank account, return on equity is the return you get on all the cash you leave in it, okay? And businesses don't necessarily reinvest all the cash they generate, but whatever cash they do leave in the business that they don't pay out in shareholder rewards like buybacks or dividends, the equity that they leave in the business, that's what that return on equity number is all about. And I just like a consistently high one, 20% and above is great. So there are a lot of businesses like, I guess the easiest one is like software. You find a really great software company and the returns on equity, they can get stupid, crazy, ridiculous. 40, 50, 60, 70%. It can be insane. And if they can keep that up for a long period of time, I saw Chris Mayer posted on Twitter recently about a Canadian company called Constellation. The ticker symbol in Canada is CSU. And it's like one of the most incredible, 100-bagger, unbelievable. I think it might even be 1,000-bagger. It's just been a huge, huge winner. And it's hardly ever had a big drawdown. I don't think it's ever had a 30% drawdown. And it's because, if you can just keep acquiring software companies and you do it right, you know what you're doing, you'll get huge returns on equity and it'll generate more cash than you'll ever know what to do with. And you can buy back the stock or pay out dividends or buy more software companies. And it can be a lollapalooza, as Charlie Munger would say. That's a great example of one of those companies. Huge return business, massive compounder, huge home run for anybody who bought it long enough ago. So that's my bit about return on equity. I need to talk about something else, though, because for some time now, well, since the beginning of the year, right, the stock market has generally been falling, although it's come up a little bit lately. So we haven't really talked so much about the speculative frenzy that I would have been focused on for most of the last year and a half. But it's still there. And we got a huge piece of evidence recently when the movie theater company, AMC Entertainment Holdings, that owns all the movie theaters, announced that they were going to buy 22% of a company called Highcroft Mining. 22% of a gold mine, because all they own is the Highcroft gold mine in Nevada. It's near a little town called Beatty, Nevada, which is near a ghost town called Rhyolite, Nevada, that was used in a film called The Island with Ewan McGregor and Scarlett Johansson. That's like the closest connection I think most normal people will ever have with this Highcroft gold mine out in the desert in Nevada, right? And so AMC, this movie theater company, of course, this is one of the meme stocks, right? You know, it went from like $3 to like $70, and now it's crashed back to about 14 or so because it's such a crappy business. Even before COVID, movie theaters were in secular decline for a decade. And then, you know, COVID hit and the revenues went from like, they had gone from like 7 billion or so to 5 billion. And then they went from 5 billion to like $1.2 billion or $1.5 billion or something like that. And now they've come back to, I think, maybe 2.5 billion or something. I'm not looking at the numbers. These are ballparky numbers, but that's about what it's done. And it hasn't made a profit since 2018, AMC. But what it has done, it attracted all these crazy speculators who ran the price up from, some single digit number. It depends on where in time you want to peg the beginning of this thing. But, you could just call it $2 or $3, I think. And that'd be fair enough, or $4, something like that, up to 72. And it happened in a few days. So now this dying business, and they have like almost $11 billion in debt, right? They're dying. They're toast. So they were heavily shorted by big hedge funds. And somehow all these little speculators who were stuck at home during COVID, they got stimulus checks. They all bought the crap out of AMC and it took off like a rocket ship. Of course, now it's crashed back. These meme stocks have all crashed like 70, 80, 90%. And AMC is down. It was down about 80% from its meme stock all-time high, right? But they were able to raise money when the stock was way up high. So now they have $1.6 billion in cash. They raised $1.6 billion in cash. So now they've got kind of a new life. And even though the thing is down 80%, it's still way overvalued. It trades at 45 times enterprise value over EBITDA, which is a really crappy cash flow. It's a generous cash flow metric. So here is this thing. It shouldn't exist. It should have been out of business by now. But the apes ran the price up and they were able to raise enough money to save themselves. And what are they doing with it? They bought 22% of a gold mine. And the thing about this gold mine that makes this hilarious is that it's not operating. They shut it down in November. They had this program to make the mine productive again because it was a decent mine in the 1980s, 1990s, but it's not working right. It's no longer an economic resource to mine. And Highcroft had this procedure, what they called this novel procedure. Let's not get into the details. You can read about it all you want in the Highcroft mining, disclosures. But they had this novel procedure that they were going to use to make the mine economic again. It didn't work. They stopped. They shut it all down and fired half the workforce, about 100 people. And, it's just been burning cash. And the thing went bankrupt. It went bankrupt in 2015. And it only went public again in 2020. via a SPAC transaction, right? So it's just burning cash. It burned 110 million of cash last year, and it's not operating. But they say, oh, we have 15 million ounces of gold, and I think 600 million ounces, hundreds of millions of ounces of silver. It's the greatest gold mine in North America. Yeah, but it's been mined out for years, and nobody can make it work right. If you know anything about mining, and I've been lucky enough to know a lot of people in the mining industry and the mining investment industry, it's a crappy business even when you get a good ore body that you can easily mine, as if that's not an oxymoron. But these guys bought a gold mine. It's so stupid. It reminds me of during the .com era when all the failing gold miners were changing their name to .com, or a few years ago, all these crappy little microcap stocks changed their name to something blockchain, and it made the stock price go up real quick, and then the stock price crashed. And now this is more substantial than that, because they invested like $56 million. They invested real money, and they invested alongside a very famous, successful mining investor named Eric Sprott. Eric is a very wealthy man. He's made his money investing in all kinds of risky gold mines. He knows what he's doing, right? The thing is, you can't just ride along with somebody like that. We know darn well nobody at AMC knows anything about mining, because any geologist of any worth will look at Highcroft Mine and say, you know something? They're never going to mine it economically. It's a piece of garbage. And these guys just AMC put was it 28 million, and Eric Sprott put 28 million into it, so 56 million altogether. And then it gets worse. The day that they announced that Eric Sprott and AMC had each invested 28 million, they very quietly, with no announcement, put in a filing that said they could sell up to 500 million worth of shares at any time. Like 10 times as much, and 5 times as much as the current market cap at that time. And before the announcement of AMC and Eric Sprott's investment, like in the days before that, the shares took off like a rocket ship. It was 6x. So somebody found out about it and bought a bunch of options and a bunch of shares, and the thing went up like a rocket. And then when the thing's up like a rocket, they announced this thing from Eric Sprott and AMC and quietly file to sell as much as 500 million of new shares. Now you tell me nothing shady is going on here. It's ridiculous. This situation is ridiculous. It's a crap mining company. AMC's CEO is from the hospitality industry. He was the CEO of like Vail Resorts. He worked for Hyatt Hotels, United Airlines. They know nothing about mining. It's insane. The speculative froth is alive. It's out there. The speculative frenzy is alive and well. I wrote about this in the Stansberry Digest, but I couldn't not tell you about it because I know not all of you are subscribers to Stansberry and you don't all get to read the digest. But this is too much, man. It's insane. And these people buying AMC and GameStop and all the meme stocks, they're going to get so completely obliterated when reality comes back and hits the share prices of these companies. There's no way AMC is worth $7 billion or even $1 billion. It's probably not worth more than a couple $100 million. It's worth pennies or something. It's worth sub $1. And here it is, with all these crazy apes saying, I'm not leaving. I'm not selling my AMC shares. Well, having a good shareholder base is quite an asset. I mentioned Constellation Software in my opening bit about return on equity, and one of their strengths is that they have a shareholder base that just won't go away because they know it's such a fantastic business and so brilliantly run, right? So maybe AMC, it's a terrible business. Obviously, they don't know what to do with this $1.6 billion that they raised from all these apes running the stock price up. And yet they the shareholders won't go away. So it's still worth $7 billion. They can even do something this dumb and the stock doesn't fall apart. Ugh. I could talk more about this, but you get the point. It's crazy. All right. Let's talk with Herb Greenberg. Let's do it right now. Something strange is happening in the financial system, and it's prompted Dr. Steve Sugarroot, a former hedge fund manager and finance PhD, and a friend and colleague of mine, to issue an urgent new warning, especially during current market conditions. You see, Steve has built a reputation as one of the most trusted financial analysts in the world by sharing a series of eerie predictions, many of which have been proven correct. For instance, in January of 2000, he wrote, "We are at the peak of most likely the greatest financial mania that will ever be seen in our lifetimes." Right after that, the NASDAQ fell more than 75%. But his latest prediction has caught many Americans completely off guard. He believes that over the next year or so, there's going to be a massive frenzy in the market, but not the kind most people are expecting right now. It's got nothing to do with cryptocurrency, Russia, interest rates, or real estate. And history has shown this type of situation only plays out 2 or 3 times every century. I'll warn you, what Dr. Sugarroot has to say is controversial and isn't being talked about in the mainstream media. His brand new presentation is available to watch for a limited time online if you visit 2022prediction.com. Again, that's 2022prediction, all one word, 2022prediction.com. It's time for our interview, and today's guest is Herb Greenberg. Herb has been a financial journalist for nearly 40 years, where he worked for the Chicago Tribune, San Francisco Chronicle, Fortune, The Street, Market Watch, The Wall Street Journal, and CNBC opposite Jim Cramer for years. For years, he was a short seller and even launched his own short-biased research firm. But for the first time, he's going long. In particular, he's interested in how the current pullback is creating some phenomenal buying opportunities, particularly in broken IPOs and SPACs. I like the sound of that already. He says, buy the dip, but buy it intelligently. Thank you for that. His exposés as a financial investigative journalist landed CEOs in jail. Yeah. Had people steal his phone records and even prompted death threats. Herb, welcome to the show. Death threats? I didn't know that.
Oh, when you do what I did for a living, you get some people a little bit angry with you. But I have to point out one thing. I was never a short seller. Came close to being a short seller. I did short research for years, but I never quite pulled the trigger on that. So some people sometimes get that confused, and I always say, well, whoa. I'm just a guy who does a lot of research and has done a lot of research on short biased as a journalist and with my research firm. The death threats. Yes, death threats would come my way. But there's one story, the best death threat I ever got, and there are different ones. I mean, look, the best death threat I ever got was a guy. There was this guy back in the AOL days, back in the old days, and he had told me, he had posted. I was working at the San Francisco Chronicle, I think, and he'd posted something, and he said, on a message board with his real name, which was the problem, you ought to look under your car next time you go outside. So we went out and contacted the FBI. And the FBI basically went to the guy's house in Shreveport, Louisiana, where he was a stockbroker, knocked on his door and said, don't you ever do this again, or you're going to have a problem. Fast forward many, 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 many years. And I get a call from the Justice Department, from the DOJ in Shreveport. Hey, there's this guy, and he's threatened the finance minister of Canada. And he had threatened you too many years earlier. Would you come and testify? So I went and testified. And the funny thing is, the key FBI agent was retired, but he said, yeah, I told the guy, if he ever does this again, he's going to have a problem. And he went to jail. But they're just people who for the nature of what you do, don't like it. And so there's a story I tell, another one that's just one of my fun ones. It wasn't a death threat, but it sort of, illustrates just what this is like. I'm walking down the street in New York, 42nd Street. I'm with a guy named Jeff Mackey, who's a friend of mine. He's does a lot of retail stuff. Mm-hmm. And we're walking, and when you've been in the media for a long time, you sort of know when people are looking at you. So there's out of the corner of my eye, I can see some guy sort of like pacing us. And he's sort of a schlumpy looking guy, and he's got a, overcoat on. And finally, he gets up the nerve to come up and say, "Herb Greenberg." And I go, "Hi," do what I always do. I turn around, put out my hand, go to shake it, and he goes, "You're the worst. You're the worst, I tell you. The worst, the worst." And I just started laughing. And then he just walked away muttering, "You're the worst." But that's, between that and the hostile emails you get, and this thing I always joke about that I've had for many years called the hostile reactometer, which is something I made up, but it's actually other people have used it since, because, certainly until meme time came, but even then you could argue it's the same thing. The angrier the responses, and there are exceptions to every rule, right? But the angrier the responses, the closer to being right on target you are, especially with sort of a shady company. And, so yeah, that's what I did for a living for many years.
So this is definitely on this podcast the first time anybody's ever said the best death threat I ever got. That's not a phrase you hear very often, if at all.
Yeah, we don't want to get any. And by the way, I don't want to get any more death threats. I've had my share in life, so I'd rather not have any. But yes, it comes with the territory.
Wow. Yeah. We had Gad Sad on the program from Concordia University, and he's gotten his share as well. But he's in the political sphere with a lot of his commentary, so somehow it shouldn't be more understandable, but it is. But all that's behind you now. This is the interesting thing about you, because, for years, somebody would say Herb Greenberg, and I'd say, "Oh, sure, that guy with all the great short ideas." So, when somebody says, "Yeah, Herb's going to come out with his own new research service, and it's going to be long only," I was like, what? So at some point along the way, there had to be an epiphany, right? I mean, what happened? What happened? Was it the death threats?
Well, it was a confluence of a lot of things. And it was a moment in life where, COVID had occurred. Think about it. I had a short biased research firm that I started with a friend, a forensic accountant, and we were in business for close to 7 years. But when you started into 2019, the market, everything we did, you just felt like everything even if it was good, it just went against you. And that sort of starts playing games with your head and it starts defeating you to some extent. But, you move on. This was my business. We had some very good years. And 2019 came along and, it was rough, but we were doing okay. And then COVID hit. But right before COVID hit, I had heart surgery. And it was something I knew I was going to have. It was my aortic valve and my aortic root and my ascending aorta. And I've followed this for years, and it was quite a journey. I went to Cleveland, had and I will say a great operation, and it was really quite a journey and an experience. And I went through it, and I came back to work into COVID. We landed in LA, the road down to San Diego, when COVID had just hit. My wife had to go scrounge, try to find food at the grocery store. There was not much there. So we landed into COVID, but I was in the hospital I was in Cleveland for 10 days, in the hospital for 8 days. When I came home, the day after I got home, I was sitting at my desk writing reports. We really didn't skip a beat. Even though I had a 9-inch incision that had been in my chest and all that, I sat down, I was tired. I almost fell asleep at my desk sometimes. But, while the recovery was very uneventful. And we started working. And then the market started going higher and higher and higher. And it was like, you say to yourself, and we're losing customers. Subscribers are getting fired. These are hedge funds are getting fired. And I just developed a very bleak outlook for the kind of business we were in, meaning the end market for short selling just seemed like it wasn't going to get much better. Our revenues had taken a very big hit, and it had taken us a while to get up to where they were. And it just didn't feel like we could ever go back to those days. And I'm a believer in, hey, if you have a business and it was up here, you want to say it can be up here again. And because that's the way I think, it's not a lucky moment. But the reality was, hedge funds the research budgets were getting challenged. We had people say to us, hey, the good news is we're keeping you. The bad news is we got to pay you less. And it just started defeating me. And then you start looking at the work you're doing. It's really good work, and the stocks are just going up. And it was hard to do, hard to find the right names. So here I am, hardly even realizing how thankful I should be that I got through this surgery as well as I did. And I never even gave it almost a second thought. 2 months later, I was back doing everything I ever did before. But we had COVID hit. And so I was getting very bored. I was really bored. I was just, what am I doing? And then I was on a podcast with this guy named Dan David, and he says, have you thought about doing activist short selling? And I thought, yeah, but I don't want to get sued. So that's like draws a line. He said, no, you'd be really good at it. You'd be really good at it. So I thought, you know what? The end of what do I have to lose? And those were the guys who were still making money. They were still you could do very well in activist shorting until, of course, I went there, right? My timing for most things is just exquisite. Right? It's fantastic. So I get there, and no sooner do I get there, and I'm about to open up my own research firm, Herb Greenberg Research. I have a guy working with an analyst who's really good, but you make no money doing this. You don't make money until you do something right. You're working sort of through a hedge fund that sort of is your one client. And it ended up, after a few months, my wife saying, when are you going to make, where's the money? And I said, well, at some point, I'm sure there'll be some. And she said, that's not a good answer. And then I started to have more time. And I started thinking about what I'd gone through. And I thought about the heart surgery. And I thought about how thankful I should be. And then it really hit me. I'm 70, and I keep thinking I'm 45. And so 2 months earlier, Enrique had called me right after I left the research firm. Enrique had called me and said, hey, we have this thing. And Enrique and I have kept up over the years. This empire thing, you're working so hard. There's another way to do things. And I started putting it all together. And I thought, I spent so many years just being negative, having people angry at me, being a public face of that. And I really gave it an audit. And I thought, what do I want to do for the remainder, right? I still want to work, and I like working, and I would hate to be fully retired. That would be a horrific thing to do. I couldn't handle that. And so I went back to Enrique, and I started really having discussions because he's high energy, and Gabe Marshank, who works with him, is incredibly brilliant and high energy. And Berna I've known for a million years, and Whitney used to be a subscriber to my first research service. So I had a talk with Whitney Tilson, and it just sort of just dawned on me. Why not do something very, very different and try to go out almost like going full circle, where I started as a newspaper journalist, business reporter, writing for the average person, right? That was my market. And when I had my column in San Francisco, that's where I really, even though I started doing short bias things there, my end market there, it was institutions, obviously, but it was people. And I'm almost coming full circle. And while a newsletter is not a newspaper, it's another way to do the same thing, because I used to write about companies whose stocks would go up. I used to do that when I'd interview money managers back before the internet, and back when that you actually could have edge doing that. You'd interview all these people. So I come back and I always wanted to work. I liked working like with my research service, working with my sources, working with a forensic accountant, working with the CFA. I like that. And now I'm back doing that with the team we have here and with the newsletter that we'll be launching, that is multiple things, because there's two parts of the newsletter. One part of the newsletter is a very straightforward, by the way, I may not be doing negative things, so to speak, but you can never take the skeptic out of me. It's a never worry portfolio, we like to call it, but you have to always worry. But it's the kind of thing where I said, I don't want to be in my car driving up to the Bay Area to see my grandson and having to think, oh my gosh, what's in my portfolio? What's in my retirement portfolio? I don't want to go through that. I want a portfolio that I don't have to think about, generally speaking. That's the main portfolio. The promotion and the second part of it is just a backdoor way into some of the, into broken SPACs, broken IPOs, because with the SPAC world, and I'll quote Enrique again, Enrique Abeta, who's a big part of Empire. Enrique would be the first to say, and he always says it, SPACs were not an asset class. It was the way companies went public. And we could, I think, all agree that many of these companies never should have gone public. Some of them are going to just disappear.
Yeah, most of them.
Right? Most of them. But I know people who are putting together funds right now to start sifting through the rubble and finding companies that now that they're public, they're fair game. And they're fair game, obviously, to be shorted, but they're also fair game to be bought at lower prices because they do have real businesses, or they will be acquired because now they can't, it's too bad. They're public and they may not have a choice. So we think there's something interesting there. And it's a way that the average guy can sort of like stick it to Wall Street because, if you had bought at the $10, you were playing the Wall Street game, or you bought at 10, maybe 12, maybe 13, maybe 14, where SPAC went. Or if you buy an IPO, you get caught up in that moment and you just buy it there's one company, C3AI, it went public I think that was the one that went public. I don't know if it went public at 45 or whatever. First day it traded 100 and change. Now it's like 20 something. And so it's a way not to play the game and come in, as we say, through the back door. And we try to find a few good names, and the few of us who are working together on this project are coming up with some good things. So that's how I got here, Dan, and I'm pretty excited about it.
A lot of drama. I'm not surprised. I can't say I'm surprised because, you've done so many things. But I'll tell you what also I'm not surprised is that you're at Empire, because this whole business, everything under the MarketWise banner, it's just become this wonderful place to collect guys like you and Enrique and all kinds of, Berna, Whitney, whoever, all kinds of people. And it just gets better and better and better and better every year for that reason. And it's really exciting. Somebody said Herb Greenberg, and I was like, really? For Empire? That's awesome.
Well, what I love about Empire, what Empire has, I have to say this, what Empire has, it's different. And it's not this different from other parts of Stansberry, but what I like about the Empire Group is it's very much the group that I sold to. It's very much the type of people who are either my sources or my end market and so I think what Empire has is it has these people who have institutional knowledge in a different way, and these are guys who really they worked for some really serious hedge funds. And here's the part I really love though, they all are short biased. So each one of them, even Enrique, who's a growth biased guy, he loved shorting stocks. And so each one of them has that DNA flaw, the genetic flaw that basically causes them to still have that in them. And I think that sometimes helps you avoid a problem, because it's like one guy I know who during the market craziness, he was working for a hedge fund, and he had to go, his fund wanted him to shift off the short book that he ran to be a long analyst. And he said the biggest problem he had versus the long analyst is he spent way too much time doing research. And that's the thing, because as a short, you have to come in and you want to know every detail. You want to know everything. You don't want any surprises. You need to know it all. And longs, you can go, it's a little different. You just want to make sure, you want to do the work. You want to make sure you're not surprised. Not that you won't be, because everybody gets surprised, shorts and longs both. But that's the issue when a short turns to long, is that they can end up having to, it's harder from that perspective. Just because you want to try to double check things.
That's right. It's hard to chill out and not be quite as paranoid, because let's face it, structurally, just in the marketplace, it's just kind of easier to be long biased, right? I mean, it just is.
Yeah, well, of course. And that's how everything's structured. And that's why I ended up becoming a short biased journalist, because I looked around and everybody was only writing things. When I was a columnist, everybody was writing things that were going up. And when I landed in San Francisco in 1988, the first thing I did was call these guys called the Feshbach brothers. They were the biggest short fund at the time. They were in Palo Alto. And I thought, man, I'd seen them quoted places in the press. And I thought, well, that's interesting. And, so I just carved it out that way.
Right. I also like the fact that, you're interested in SPACs and busted IPOs, because it's interesting, isn't it? Like we had these, kind of multiple bubbles going into early 2021. And some of them, and I would say cannabis is another one, have just gotten so obliterated that they've become really, they're value plays practically, right? There's really interesting things to do. And not only that, but, the survivors in SPAC land is another thing, because, a lot of really sketchy companies go public via SPAC, and some of them are found out rather quickly, to put it mildly, and wind up trading below, the SPAC price pretty quick.
Yeah, but I think what you find is, it's funny. Gabe and I are going through. Gabe works pretty closely with me on this, and I value his just general institutional knowledge of just everything, and he's brilliant. Besides the point, and when you look at broken IPOs, it's almost, when you look down the list, it's harder sometimes to find a really good one. They're broken for a reason, because they came so, if they were, were they a cast off of PE, private equity, loaded with debt? It was the perfect time to exit because things and prices and valuations were so high. Were they a cast off of venture capital, which could even be arguably worse, because venture capital, this was one of their dogs, and this was a perfect ability to get rid of one? Or were they just seizing the moment, right? And we found, like we were talking about one today, and it's an amazing company. It's been around forever. A little not everybody's cup of tea of type of company. It's probably going to be in our portfolio, and it's one of those names that came public. It was part of another entity. It's pretty darn interesting, and it's a solid company. And that's the thing. If you're looking at an IPO, or if you're looking, say, at the broken SPACs, one of the broken SPACs we're looking at is still an emerging company, but it's got hundreds of millions of dollars in revenue. It's raised its guidance. It's currently profitable. I say currently because it probably won't be all the time through. It has a fascinating business model. I think the CEO is genuine. I'm always nervous about those, but and we're almost ready to pull the trigger on, making sure. We'll see what they're going to report earnings on Monday. And they're going to be at the Roth conference on Monday. So those kind of things, if anything blows it up at that point, it could come right out of the portfolio. But that's the kind of stuff that's out there too. The companies that actually are doing well, and there's some in Enrique and Gabe have the Empire SPAC Investor, and in that there's several that are really fantastic, that are just really that's how they came public, and
Very cool. Herb, before we go on, I'm sure our listeners right now are saying, okay, well, what's Herb's new service called? What's this newsletter I need to get?
It's called, this is going to surprise you. It's what it's called. It's called Herb Greenberg's, it's called Herb Greenberg's Investment Opportunities. So it's HGIO, and so we're specifically, one thing I said to the folks at Empire when they wanted to hire me, and I was very adamant about this, because just based on my personality, I said, look, I have an IRA, I have a 401k, I have an IRA, I have a retirement, a type of retirement account of a bunch of different things that I put together over the years. And I said, I want this to have the kind of things I want to own.
Yep.
I don't mind having a high flyer or two, because I like high flyers or two. I like a little lottery ticket fun in my life. Mm-hmm. But most of it, I want solid. I want things that are going to grow. They're going to be 2 to 5 years. These are not razzle dazzle. And hopefully, if we're really doing it right, they're companies everyone isn't paying attention to. And it's not going to say we're not going to have one of those, but that's the goal. And as I look at the companies we're pulling in right now, because we're going to launch with 5 to 7 in the main portfolio, these are companies I can tell you, some people go, huh? I never heard of that company. Or, oh, boy, that one? That's interesting. Forgot about that. Mm-hmm. Or, one of those type of things. So they're not names that I call them TV names. They're not names that pop up every day on the air.
That's good, because people love that. I mean, I've been doing this for 20 plus years, and it's one thing if you recommend like Berkshire Hathaway or something, It's another if you find company XYZ that no one has ever heard of, and it turns out to be this amazing winner, and everybody goes, wow, Dan Ferris or Herb Greenberg or whoever is the only person I ever heard talking about this thing. I can't wait to read this. I really can't. Just because I've read your stuff for years.
I hope you give us some good feedback. Yeah, well, it's going to be, it's a little different. It's different than what I did at the research service, more like what I did at newspapers. The narrative is what we did in newspapers, and with a little the financials thrown in. But yeah, I'm excited about getting going with it, and I think we, look, there are thousands of companies in the market, right? There are thousands of public companies, and I'm always surprised. Every day, somebody mentions a company, and I go, I never heard of that company. And you want to almost be embarrassed. But the good news about aging is that you can say, very little embarrasses me anymore. So you can ask stupid questions, and you say, where did that company come from? And you realize it's got a market value of several $1 billion, and it just wasn't in my line. There are so many companies. You can't see them all. You can't know them all. And that's the beauty of it. And that's what keeps my brain functioning, looking at some of these and having and trying to find some good ones.
So the process has got to be different. I mean, you've already talked about the mistake that folks make when they switch from being short focused to long focused. Presumably, you're working on not making that mistake. So your process has to be somewhat different now, doesn't it? What are some of the biggest, most important differences between the way you used to operate as short biased and the way you operate now as long biased?
Well, the first difference is, instead of saying how low can it go, we're sort of flipping that on its head. But we are actually, because of my bias, look, I always looked at a proxy statement, and I still look at a proxy statement. And one of the first things I always do when I look at a proxy statement is to look at how the CEO or management is compensated. And this is not a foolproof method of doing anything other than if there's a problem or there's going to be a problem, and you see that someone is compensated by just earnings per share or just an adjusted number, one or two metrics, that's a red flag to me. That said, I have, I think one or two that we're adding have I wish they had better, but like I've got another one we're adding, and man, management has to jump through such hoops to get a bonus, return on invested capital plus through two other things. And when you see that, you get excited. And then you see that management really is, that the board, it's a good board, and they're holding management's feet to the fire. So when I was on short biased, I would automatically look at it and say, oh, these guys, the motive, because I always look, what's the motive to stretch? What's the motive to commit fraud? And the motive would be that we can easily strike our bonus, and the culture of the company is to be as aggressive as possible, and management just wants to make as much money for itself every year, and by the easiest way, and the board will let them do it the easiest way. So short bias, that'd be one of the first things I'd look at, because I always worked with a team of people who did the numbers, right? These were the experts, the financial. I always had the analyst and the forensic accountant. This time we're coming at it a little differently, because we're looking at the business. And if I look at areas where I've seen short sellers get it wrong, and I have great respect for short sellers, I think it's the hardest thing in the world to do. And I look at things we got wrong in the research side, things short sellers got wrong. Sometimes it's where there is a good business, an emerging business. Their financials may be a little aggressive. That can be a false negative, right, or a false positive. But the management is executed so well. So it boils down to, you're looking far more seriously at management, and you're looking really at the strategy. Do you believe the strategy? And does the strategy make sense? What's the competition? And you're looking at it just, again, it's upside down. And then the numbers. Do the numbers make sense? And one thing we're looking for is we want businesses that are just throwing off great, free. Everyone wants these, right? Good free cash flow.
Yep.
We want a balance sheet that's a strong balance sheet. Again, these are all holy grails. Our current companies all have them. But those are kind of, profitability is really important. Valuation is less important, as is usually the case, but it's more important for us. It's like the minute I said I was looking at one of these SPACs, and I said to Gabe, I said, there's things that, 2x sales. It should be a 4x sales. He said, I do not want to hear any multiple of sales. Please don't go there, which is the right answer, because that's the way everybody played things in the height of the market. So instead, you're looking at companies that are selling at a discount to the market that could grow faster than the market if all goes well. And if they're not growing faster than the market, they're generating huge amounts of cash, and they're great capital allocators that will ultimately return cash to shareholders through dividends, through buybacks, through growth via acquisitions if done properly, because we all know that can be a trap too. So that's the kind of stuff we're looking at. And again, we're bouncing it back and forth between the team because everybody has institutional knowledge, and we also want companies that we enjoy working on. So there's that component too. You can only have so many boring companies in your life. So
right. If anybody is interested in learning a whole lot more about Herb, and I'll give this URL more than once, okay? But let me just tell you can go to www.herbevent.com, HERB event.com, and sign up for a really great event where you're going to learn a whole lot more about what Herb is doing. So I wonder, Herb, I understand if you can't do this, but is it possible? Can you throw a name out for us, or would you prefer to just keep them all for your paying subscribers?
Yeah, I want to keep them all for our paying subscribers.
Sure. Okay.
At this point, I think we want to just keep everything out there. But I will say that, one of the companies we're working on is a company. This is one of the things. It's one of the themes we're doing is we're calling it the Herb method of picking stocks. Now it's, how this is. Everybody has they love the acronyms, and and I thought about it, and part of me thought, do I really want to do that? And then I thought, well, what do we stand for? What do we have? So the H is hiding in plain sight, and the E is eclectic, and the R is real. We want real companies, and the B is just a balanced approach to financials. B's are really hard to find, let me tell you that. Mm-hmm. So because I didn't want to put balance sheet, because you could have, depending on the company, it might have a little bit of a stretch balance sheet. There might be something going on, but they may have fantastic cash flow or something. So we just try to be a little different. So especially with the SPACs, they can be a little more difficult on some of that, which gets us the eclectic. But this one company is such a hiding in plain sight. And what I love is it's one of those companies that every single person who you mention it to goes, oh yeah, they do X. Well, while nobody was looking, this company that has a great capital allocator, has great cash flow, very solid business, has literally diversified away from X. But X generates the cash that supports the growth as it moves into these other areas. And it's really fascinating. And management is just very conservative and very disciplined. And, that's our approach. So it's sort of like, it's a situation that, the kind of business, I love that kind of situation where people just weren't paying attention. Right. So that's one of them. And it's a big company. It's multi-billion-dollar market cap. It's a nice business.
In other words, and you actually see this more often. I've seen this more often over the years than I could believe. I mean, with some people who are, who are really great analysts, they'll say, oh yeah, that's the company does this or that. And you think to yourself, well, yeah, but that's not quite the story. It's not what it appears on the outside. And when you just sort of lift up the hood and look underneath, there's something even better going on inside. I can't wait to find out what that name is. I'm going to herbevent.com and signing up.
You know the name.
Oh, okay. All right. How about that? So we'll recognize it. And yet those are the ones you recognize the name, and yet there's something more going on than you thought. Really looking forward to finding out what that is, because those can be wonderful. That's a characteristic of a potentially wonderful situation. Great. Is there anything else that you'd like to sort of describe in the abstract? Don't give us a name. That's for your subscribers. But anything else that you can sort of tease us with?
No, I think we're in the process of just trying to button up the portfolio, and I
Okay.
think that I think that I look at some of these, and I'm just thinking through the list, and I think I'm just thinking, no, 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 there's nothing I can really tease you with. I think I just want to get settled on these. We still have a lot of work ahead of us in terms of just putting the reports, finishing up some of the reports, and yeah, I wish I could
No, that's cool.
shed more insight, but yeah.
Hey, that's cool. I get it. Believe me, I get it all day long. So, Herb, I actually, I have this special final question that I ask all guests. And before I do that, I do want to say one more time, go to herbevent.com, sign up for Herb's webinar, find out all this great stuff, and sign up for his product. I haven't known Herb for years and years, but I've known his work for years and years, and it's excellent. He has a fantastic reputation, sterling. And but Herb, my final question though for you is the same for every guest, even when we're not talking about finance. And you don't have to confine yourself to finance in your answer. And the final question is, if you could leave our listener with a single thought today, besides going to herbevent.com, what would it be?
Oh man, what would be a single thought?
Yeah.
You know, it's trite, it's cliche-ish, but it's what I've learned and I've gone through these past few years is really life is too short to surround yourself with toxicity, and I have made a very concerted effort to try to remove toxicity from my life, and with social media, there's a lot of toxicity, there's a lot of divisiveness, there's a lot of anger, there's a lot of trolling, and I think it pollutes your brain. And I've always tried to stay above the fray. I try to never make things personal in my entire career, because even when I'm going after a company, people have families and people have, they're people, right? And people make mistakes. Some people intentionally make mistakes and they deserve to be outed. But the rest of this is just nonsense. And so I just think the best you can do to remove yourself from toxicity, and it's extraordinarily important, I think, especially right now. And so with everything that's been going on in the world, it's certainly one of the big changes in my life as I've tried to make these changes is to just, try to enjoy life a little more. And but certainly to just try to control the inflow so you're just not as polluted. So there.
Well said. I mean, and I hear you. It may sound a little trite, but that those things become that way because they're true and they're repeated all the time. So I think you're spot on, and thank you for that. I have to tell you, man. Once again, I hope I haven't said this too much, but I'm really glad that Empire has Herb Greenberg, and that you're a kind of part of the fold now. Really happy about that.
Great. Well, I'm glad to be here, and hopefully next time you're down in San Diego, we'll have dinner.
Absolutely, man. Absolutely. Next time I'm anywhere near that place, I'm giving you a ring.
Okay.
All right, Herb. Thanks a lot, and you'll be getting a call or an email from us in 6 or 12 months, and we'll be checking back in with you for sure.
Anytime. My pleasure.
All right. Thanks, man. All right, so at the risk of repeating myself, go to www.herbevent.com and check it out. And I mean it. I'm being very sincere here. We have just attracted some wonderful people. And Herb mentioned Enrique Abeda and Berna Barchet, who are both part of Empire Financial, that the group that Herb works with now. And he's right. They're just stellar, high quality people with some really great insights. And he didn't say this, but I'll say it. He's one of them. And I've read his work on and off over many, many years, like 20 plus years. He was one of the first people I ever heard about when I got into the business of doing research for readers. And he's just been a steady stream of really good, mostly short ideas, but now he's on the long side. So please do check him out. I promise you'll get something that's very high quality. www.herbevent.com. Check it out. All right, let's take a look at the mailbag. Let's do it right now. Mark Chaikin, who I've had on my show more than once, someone who spent 50 years on Wall Street, is sharing his newest prediction for an event in 2022, and his video has gone viral with 1.5 million views. Have you watched it yet? You see, according to Chaikin, a historic event in 2022 will cause a massive shift in the wealth divide. This will affect everyone who owns stocks, and unfortunately, most people will never see it coming for the simple and sad reason that nobody wants this to happen. You see, Mark Chaikin predicts a new form of technology will disrupt everything, and it's all a direct result of 2020. Chaikin, a popular guest on Jim Cramer's Mad Money, has never shied away from sharing his controversial predictions. This event will affect everyone from Apple to Amazon, and the best way to prepare is to simply get the facts for yourself and see what's coming. In fact, 11 of the world's best-known billionaires are getting ready for the shift right now. To learn more, visit strangeday2022.com. That website again is strangeday2022.com. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Send questions, comments, and politely worded criticisms to feedback@investorhour.com. I read as many emails as time allows, and I respond to as many as possible. You can also call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. First up this week, and by the way, folks, fantastic job, huge mailbag, lots of good stuff. First up this week is Don S., and he says, Dan, great work. Your ideas about a value growth cycle make a lot of sense to me. Can you discuss what to look for in a good value fund or ETF, and perhaps give some examples of funds ETFs that match your criteria? Thanks, Don S. Don, it's not hard. I don't need to give examples. Just there's a whole bunch of value funds out there, all right? There's too many, frankly. Just look through and make a decision about what you're looking for, because there's all kinds of ways to come at this. You know, there's mid-cap value, small-cap value, big-cap value, every kind of value you can think of. There's a Japan value fund. You know, there's probably European value. I mean, I was looking through a list this morning. It was too long. I couldn't finish looking at it in response to your question. But just make sure you look at things like, you know, what the expense ratio is. I checked out one Vanguard fund. You know, the expense ratio on Vanguard is tiny. It was like 0.07%. And that's good. But basically what I want to do is personally have like, you know, I want emerging markets value, and I want a little bit of Japan value. I want some European value, and I want to capture the effect over time. That's what I'm looking to do. So if you look at something like maybe like a Russell 3000 value fund, it will capture the effect over time, but it also, I noticed that it overlaps a lot with the growth fund, right? Because you can wind up picking some of the same stocks using different criteria. So Don, I'm sorry, it's not a satisfying answer, but look at the expense ratios. Think about how you want to put it together. I told you how I wanted to put it together, Don. Just think about how you'd like to put it together. Do you want to have all the stuff I said? Do you want, you know, Japan and emerging markets and Europe and whatever else? Mid cap, small cap, big cap. I've stayed away from big cap value funds. I just want the smaller cap because I want a little more juice to it. When it really, you know, if the cycle really gets cooking. So, you know, just make some decisions about it and look at those expense ratios. And I'm sure if you just stick with it over time, you'll capture the effect quite well. Next comes Mark R., Stansberry Alliance member Mark R. And Mark says, Dan, really enjoy the Investor Hour. I used to struggle to understand inflation the way many of your listeners do, until I heard Dr. Lacey Hunt. He corrects the past definition of inflation as an increase in M1 to the correct definition as M1 times velocity. In 2008, 2009, there was no velocity because when the Fed simply pumped fiat currency into the bank's balance sheets, it went nowhere. Bank lending is one way fiat gets velocity in the market. When Mnuchin and Powell dumped fiat directly into our checking accounts, inflation took off like a jackrabbit at a Greyhound show. I would like to hear Dr. Hunt as a guest on the Investor Hour. He's brilliant and explains economics in a simple, down-to-earth style. Yeah, I would like to have him on the show too, Mark. He says, thanks for the SIPP, the inflation protection portfolio that we put out recently. I'm sleeping well at night and part of the afternoon too. Stansberry Alliance member Mark R. I'm just going to let your comments stand. It's a different way of saying what we've said, right? We need the bank reserves get placed into member reserve accounts, basically, and you're right, they don't go anywhere. I've said this a bunch of times, but they need to get lent and spent in order to create real inflation. And when they get dumped straight in the checking account, yeah, then they can cause inflation. Next is Lodovik H., our longtime listener and faithful correspondent. Lodovik, you had so many questions this week. I'm sorry, I'm a little overwhelmed, so I'm just going to take one of them. Would you favor gold or silver, and why? I'm considering acquiring 50 kilogram silver bars, or 50 kilograms of silver bars. I could spend the same amount on gold, thinking about what to do to save some profits, Lodovik H. Lodovik, to me, I think of gold and silver as one thing. So when I buy gold, I always want to buy some silver too, generally speaking. It's just, I think of silver, it can act like gold on steroids. It can, if you look at the long-term silver chart, it gets these spikes in it. Like it hasn't hit a new high as gold almost did recently and did a couple years ago. But it does have this spiky tendency. So it's kind of good to hold some silver and even silver equities, I think, to take advantage of those, and you can sell into those spikes. But really, for me, gold and silver, physical gold and silver that you're talking about, I just buy them and I don't sell them. I told y'all I sold some gold, like, what was it, a couple of years ago or something, because I used it to buy gold stocks. And I still, this gold stocks did okay. Actually, they did well, but I still regret not having the gold. I'll never do it again. I'll never sell gold or silver again. All right. Steve L. is next. Trying to find website for the update mentioned in this morning's podcast when you spoke about gold, something that you suspect will move up 1,500%. Thank you, Steve L. Steve L., it's called danupdate.com. danupdate.com. Next, and no, not last. There's a bunch more. Next this week is Kieran M. And Kieran says, hi, Dan. I recently heard someone arguing for a model of banking where banks take equity stakes in small and medium enterprises. He said SMEs. I assume that's small and medium enterprises, that they extend credit to rather than the current model of low capped upside and up to 100% downside, which Nassim Taleb often inveighs about in his books as the opposite of optionality and thus being an undesirable business model. I heard in your latest podcast talking about how money creation really works with banks. Given that banks are normally incentivized to extend credit against far less productive assets, such as property, so they can seize in the event of a default, is this preventing a lot of firms from getting a start and thus giving up easy economic growth in the process? I know there's private equity, venture capital companies, but they can't create money themselves and might not be interested in small fledgling businesses anyway. What do you think of this potential new model? So you're talking about a model of banking where they take equity stakes in small and medium-sized enterprises to which they also extend credit. I think they've taken plenty of risk extending the credit. They don't need more risk taking the equity stake. The equity is what gets wiped out before the credit, right? So they don't want to go buying insurance. You're like selling an insurance policy, right? You're paying out. When you lose your equity, you've paid out. So you don't want to go selling insurance policies on the thing you're lending money to. It doesn't make any sense at all to me. My thing about banking is, this 10-to-1 fiat currency fractional reserve system is inherently risky, as Nassim Taleb rightly identifies. And, 100% downside, limited upside, and they get, if they're big enough, they get bailed out by the Federal Reserve, so they don't have any incentive to behave particularly well. And I think that banks should be like any other business. They shouldn't be backed up by the government or the Federal Reserve or the printing of money, and they should be responsible to their shareholders and responsible to their depositors, right? They shouldn't be lending out your deposits 10-to-1, and they shouldn't be so levered up. It seems a little insane. They shouldn't be allowed to throw money around the way they do. They should be lending out their own capital and taking good care of their depositors and shareholders, and they should live and die by how well they do those things. But it's a good question. I'm glad you asked. I'm glad we should talk about banking every now and then because it's an insane business. Next comes Aussie Stu from Down Under with another question. Tell you, when it rains, it pours. Bring on the questions, Stu. I love it. He says, "G'day, Dan. I have so many questions right now, but I'll try to limit them. Dan, for a long time now, you have pointed out that we are, in fact, in a bubble and stocks by nearly all measures are overvalued. Well done, by the way. You have been one of the few people to warn us. But in the last month or two, I believe over half of NASDAQ stocks have lost over 50% of their value. Some are down 60% or more. And those that are down are not all rubbish. Some are quality stocks. Dan, my question is this. Is this the sort of damage you were preparing for? How nasty do you see this getting? I know you don't predict, but I'd appreciate you telling me the future so I can plan accordingly. Ha ha. I'll answer that before I take on your second question. Yeah, a quality stock down 50 or 60%. Yes, Stu, that is exactly what I'm talking about. And no, I don't care about the performance of the index necessarily. That's kind of a benchmark. I've referred to them often, but it's only to express the idea that I think a whole bunch of stocks are overvalued, and I think a whole bunch of them are going to fall, and a whole bunch of them have. So yes, if you find something of value in that down 50%, down 60% cohort, over half of NASDAQ stocks that you mentioned, that's exactly what I'm talking about, buying. And that's exactly the type of performance that I was worried would happen. But, ultimately excited for because it's an opportunity. Okay, Stu continues. My second question relates to holding stocks without a stop loss. Many forever stocks and crown jewels are down considerably. What is the mindset here? Do you hold on knowing that they will rebound in time, or do you add to the positions and take advantage? It really is tough to watch any stock drop and not use a stop loss. But with a best business, maybe I should not be so concerned. Love your thoughts. Keep up the good work, Aussie Stu. Oh, Stu, you guys, you asked the best questions, and I'm so afraid that the answers will be unsatisfying. You want me to say, yes, do this, do that, but no one can give advice of that kind. We can give you the tools, right? Use a stop loss or don't use a stop loss. If you don't use a stop loss and you're wrong, you'll lose a lot of money on that position. If you have a whole bunch of positions and they do well in the aggregate, hey, maybe you're okay. If you do use a stop loss, maybe you stop out and the stock turns around and performs great. These are all real risks, things that can happen. Nobody can give you off-the-shelf, simple financial advice that will just work all the time. It just doesn't work like that. But what stop losses will do for you is prevent you from incurring a catastrophic loss because you say, well, let's say your stop loss is 25%. You sell automatically when you're down 25% for fear that this is the kind of business that could be down 80% and never come back. Now, technically speaking, any company can do that, but do you really think that Costco is suddenly going to turn into a crappy business if it's down 50 or 60% or something? I don't know. At that point, you'd have to reevaluate Costco, but it sure looks like a fantastic, durable business model to me. And you do the same thing with, Berkshire Hathaway or any great business. We have a whole list of them in extreme value. So I don't want to mention. I mentioned Starbucks before, and Waste Management, and maybe Home Depot that we've recommended. But I don't want to mention any more because we have subscribers. But you get the idea. You have some thinking to do when the stock is down a certain amount. And before you buy it, you should decide whether or not it's a stop loss stock or a hold forever stock or whatever you're doing. And your strategy, like, I can't possibly know your risk tolerance. Maybe you're the kind of person who just gets so nervous and you can't handle it. And if you can't handle it, you should sell when you're down 20%, because if you're down 50%, you're not going to be able to sleep, right? But maybe you're the kind of person who really, truly is a long-term investor, who really can truly sit through a bear market and not sell great businesses and maybe add to them, as you suggest. There's no simple answers here, Stu. I'm sorry. It's just the way it is. But we should ask the questions constantly for that very reason. Okay, finally, last this week is Steve M. And Steve M says, hi there, Dan, and any of the Stansberry Digest editors. In short, what's your prognosis for the dollar as the world's reserve currency? To my understanding, hegemony of the US dollar rests upon the strength of our economy, respect for our leadership, skillful deployment of our military, restraint in dollar creation, and use of the dollar-based exchange system's power with respect for other nations. Thanks, Steve M. So we recently, in the digest, I think it was Corey McLaughlin, published a chart that we have published from time to time that shows you throughout history that every 100 years or so, the world's reserve currency changes. You know, change from Portugal to Spain to the Netherlands to the UK. I think I might be missing one in there. And then to the dollar about roughly 100 years ago, right around the time of World War I. So it's been 100 years. People are getting nervous. A lot of dollars have been created. We're seeing inflation. This is a good question to ask. And not only that, but like, did you notice that we could basically cut off an entire country's access to their foreign exchange like that? The banking system just cut off Russia's access to its foreign exchange like that. Wow. Okay, that's interesting. And you said, the hegemony in the U.S. dollar rests on strength of our economy. Well, it won't be strong forever, will it? And it's not going to be as strong as it was when it was younger. Respect for our leadership. God, who has that? Skillful deployment of our military. We go around the world whacking at hornets' nests and creating reasons for people to hate us and terrorize us. Restraint in dollar creation. Ha! No such thing. And use of the dollar-based exchange system's power. Well, that's still there, right? 80% of global transactions, almost 60% of global foreign exchange. Like, it's really still very hard to sell anything without buying dollars. And as long as that's true, you can't say, the world's reserve currency is doomed. It probably is doomed because all fiat currencies are doomed. And as we pointed out historically, it's just the way of things for this to change. The problem is not figuring out the world's reserve currency is doomed. It's figuring out what to do about it, right, Steve? That should be the ultimate goal with a question like this. What do I do about it? And aside from buying gold, silver, Bitcoin, and great businesses, which can produce a really great return and fight inflation, I don't really, I don't know what else to tell you, man. Land, real estate in a politically stable place, whatever politically stable means in the year 2022. It's not an easy thing to deal with. You got to be ready for some pain if you think that the world's reserve currency is really in big trouble. I'm not sure that it is, but eventually we know it's doomed. So it's kind of imminent. Is it imminent? Because we know it's inevitable. I don't know if it's imminent. It's a great question, Steve. I could probably sit here, rambling on about it for a half an hour. Nobody wants to hear that. But thank you, Steve. These are questions. You guys asked such good questions this week because these are things that are difficult There's no pat answers to a lot of this stuff. Great job, guys. Can't wait to read next week's mailbag. Well, that's another mailbag, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did, and I really did. We provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might enjoy it, tell them to check it out on their podcast app or at investorhour.com. Do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts, and while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @Investor_hour. Have a guest you want me to interview? Drop me a note at feedback@investorhour.com or call the listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.